Hey there, it's Bionic Bob. I'm the CEO of Geomatrix in Hong Kong, managing director of Akamai to build homegrown talent in Hawaii. So the Akamai Finance Academy, what we do is we train students. It's a free program, which is both good and bad, and in asset management. And they're usually University of Hawaii students. And we teach them based on hedge fund professors at three universities who develop the curriculum, really how to compete with the Princeton eating clubs for the top paying jobs on the planet. We have changed the trajectory of 60 lives, young lives, over the last 20 years in Hawaii, launching them into financial centers around the world and also starting to build a talent pool for returnees who want to come back and raise their families in Hawaii after leaving Hawaii, the brain drain. And we're also launching several homegrown asset managers who are graduates of the program. So we've been around since 1996. We're SFC registered. We have a beautiful office in Soho on Hollywood Road. Please come visit us. There's great eating around there. The main fund we're going to talk about is 19 million. It's a family and friends hedge fund. It's all of my assets except for some property. I focus on this because it's, our future. And we also have a few friends in there as well. We also seed friends as they want to launch mostly Asian strategies. And those Wickham it's been with us for quite a while. And it's a deep value Hong Kong. We'll talk about each of these. And then we have an India fund. We've launched several of our graduates with small allocations to get them a track record. This is a big part of our assets, but at a low fee. And it doesn't really relate to this, but just a total picture of our assets under management. About 90% is a private equity fund. So the strategies, the Akamai Master Fund, this is the main thing that's adding value here in creating this performance. It's a global equity long short fund. Then we have 10% in India, 10% in deep value Hong Kong, and 5% each in the graduates. So why India? Well, it's the only market in the world that's outperformed the US over a long time period. Why Hong Kong? It's drastically underperformed. It's had 5 years of losses, never before in its history, and we own the cheapest stocks in the cheapest market in the world. So why India? Well, there's a rule of law thanks to the British. There's both cheap labor and very educated labor. If any of you have worked with overseas Indians, you know what I mean. We're big in Japan. About 60% of our fund is long Japanese stocks, and their winter is over. They're developing a return on equity culture. China is hated and it's bottomed, and it's becoming a dominator in electric vehicles, AI, robotics, and they graduate 10 times as many engineers every year as the US. We've also been raising our exposure to Europe. Germany's now over 20%, and they've been forced to kind of wake up in the last few years, and it's very, very cheap. We have a market pro in each market, and then I'm overlooking everything, and I'll go over my background. So these numbers are pretty good. I mean, we've basically almost doubled the performance of the S&P and 6 times the Asia. And this is without owning the Magnificent Seven or the Magnificent 10. We do have some positions in a couple of these, and we'll show you. But we've basically now the top 10 stocks in the U.S. are 40% of the index, which means that all benchmarks institutions have to buy them, and momentum-driven retail investors are buying them. And at some point, this concentration begins to fall off. The latest one, as of this presentation, was Amazon, which disappointed, and now sort of it's falling off, and it's like a pond with ice, and investors want to skate to the last unbroken ice, and they're 10, and then they're 9, and they're 8. It's like the Agatha Christie 10 Little Indians, or one of these murder things, which one by one the top stocks get murdered and fall off until there are only 1 or 2 left. That is usually the end of a bubble. And we are investing not in these stocks, but in an incredible array of global companies that are doing very well and well managed, and they're bargains. And that's why you're seeing these sorts of numbers. Well, let's sort of look at it in 2022, which was a bad year for the markets. The interest rates went up. Markets were off. It was almost a bear market. We were up. We weren't as strong in 2023 and 2024. Those were pretty good markets, but we were up. We didn't fall. And then let's look at at the first quarter of this year, the market there was a tariff tantrum, and in April, markets dived, particularly the Magnificent Seven or Magnificent 10, and we were up in that first quarter. Now we lagged the market in the second quarter, but we're really doing very well here, for instance, in July and August. So this is basically what you're going to get is long-term outperformance with low correlation, meaning this is a very smart diversifier. It's better than bonds. It's better than the S&P 500. You really should consider this as a small allocation. So, how do we do this? We go long, meaning we're betting that the companies are going to go up when they have rising earnings forecasts and rising ROE. And the opposite, we sell short, meaning we borrow stock and we sell it and then cover it at a lower price. We're betting on these companies, their share prices fall. And we consider valuation, but really it's all about profit momentum. So let me show you one of the few Magnificent Seven where we're long is Meta. It used to be Facebook. It dominates in social media, and it's using AI very well to target ads to us. And if you've used Instagram or Facebook, you know what I mean. Mark Zuckerberg understands exactly what you want and what you need. It's not cheap. The PE is at 27, but look at the earnings. These brightly colored lines, the last year earnings did rise, and that's the green line. The forecast for this past year is the white line, and then for the current year and years forward, it's rising to the chartreuse line, which is 3 years out. And that's what we want to see. We want to see expectations rising from Wall Street. These are earnings estimates by Wall Street analysts. And when you have rising profit forecasts, it drives share prices ever higher. Now, also in the Magnificent Seven, there's Apple. And the new iPhone cycle and their AI implementation is not very impressive. Look at that earnings momentum. Those brightly colored lines are downward. And that's the kind of company, and it's not cheap. It's more expensive than Meta. And that's why the falling forecast removes the high valuation rationale. We're very short Tesla, and the competition, particularly from China, is severe. The founder has been distracted. It's very expensive, and forecasts are falling. And it really shouldn't be so expensive. We think this could fall 50% from here. JP Morgan, the global dominator in banking, the positive yield curve helps their margins. These users of AI, think about what a bank is or insurance company. It's a lot of white collar people pushing papers and spreadsheets. And that's what AI is going to eliminate. So the savings from white collar workers in banks, in other financial companies is huge. And the stock is cheap. Look at those rising earnings, profits forecasts in JP Morgan and all the banks in the world. We've been looking at one of the Japanese banks, which was a merger of three banks that were essentially bankrupt in the terrible times. Japan's in a new high. This has a very large deposit base, and I think it's selling for less than cash per share. It's, again, the AI savings. The Japanese are going to be slow to replace labor, but then again, they're running out of labor. Japan is running out of Japanese. They will be implementing AI as well. Very, very cheap. So this is a Chinese stock. It's a leader in technology, electric vehicles, your cell phones. They really compete well with Apple and the Google Android. Automated homes. I've visited them in their showrooms. It's pretty impressive. They have a 6 football field campus where they're inviting foreign scientists who are being laid off in the U.S. to come and do research. It really is a global dominator in technology. So this is our standout European holding, which is a defense stock, and they produce turrets and projectiles for all of NATO. And of course, we're gearing up as the world gets to be a more dangerous place. They have a very reliable drone defense, which paints the sky with small projectiles and can knock out 100 attacking drones. It's not cheap, but basically we ride our winners. We don't sell a stock on valuation as long as earnings are continuing to be revised up as they are here. So we are 168% long. This data is a little bit out of date and short, but it just shows you your money's working hard. For every dollar you invest with us, it's actually 2.6 times between the longs and the shorts. And we're trying, our best to make you money on both sides and protect your portfolio. If there's a bear market, we're back over 100% that long. Back in the end of May, we were still a little bit cautious after the tariff tantrum. So if you look where our country exposure, we are big in Japan. It's 50% 30% in Japan, we're 32% and 33% in China, Germany's 21%, and we're actually net short the US, where the profit revisions were negative. They've turned a little bit more flat now. We're long the financials, but we're short technology in the indexes. Japan, we're very bullish, not just financials, but there are defense shares there. China, as I mentioned, Xiaomi is a best example. And in Germany, we're long Commerzbank and Deutsche Bank. We're incredibly cheap, and they're really getting their act together. And of course, Rheinmetall and others in defense. So I'm going to move a little more quickly, but basically you can see where the financials have been our biggest bet. We're long the yen. The yen is the most undervalued currency in the world. And this is a little bit on structure. We can go into more detail if you're interested. My background, I've been investing actually since I was about 16 years old. I founded Geomatrix in 1996, and that's 30 years, and Akamai 20 years ago when I moved to Hawaii. Before that, I was the lead investor in Asia in Japan for AIG, for Asia overall, for T. Rowe Price and their joint venture with the Fleming Group. And before that, I started in my professional career at T. Rowe Price in Baltimore, where the waitresses call you hun. I was a technology analyst, which has been really useful. I did econometrics and really, quantitative analysis at a company called Data Resources. And I started as a country analyst in Central America for World Bank right after graduating from Yale. At Harvard, I was really focused on investment management. And when I was in Japan, I co-founded the Chartered Financial Analyst. Lots of awards, number one performance. This fund would be a number one performer in some of these league rankings, but it's only a family and friends fund of 19 million. So, we don't qualify in terms of size. I've been with my partner for 30 years. He joined us first as a quant, director of research and trading at Rutgers. I don't know if you know this, but they were almost going to enter the Ivy League. It's incredibly hard to get into, particularly their engineering program. It's a state university, but like a lot of state universities, is totally upgraded their game. He's also a CFA. He's been working with us for 30 years now, and he's basically the one who's running this fund, and I look over his shoulder. We have some sub-fund managers, the Hong Kong fund, the India fund, and each of those managers is launching kind of an opportunistic fund. And we have two of our graduates that are launching really, small. We give them a little bit of the fund to manage, and they grow into it. And the idea is to get a track record and help them raise assets in Hawaii from their friends and family. So the India fund is slightly outperformed over long time periods. I'll go into the background of the founder here. He has been managing money Ambar Taneja has been managing money in India for 22 years and always outperformed. And good storied background, very, very good background. He's got an analyst he's worked with for years, and they have offices with us in Hong Kong, Delhi, and Goa. This is the Hong Kong fund. It's outperformed the small cap index, but lagged a little bit the main Hang Seng. And basically, the smaller companies are, this is the cheapest market in the world. It's really been sold down for 5 years, and the stocks that we own are the cheapest stocks in the cheapest market. As I said, he's a veteran. He's been around. He's been running this. He just launched kind of a short-term trading fund, but he's been with us, since it's really been 15 years. It has. It was big in derivatives at Credit Lyonnais, which was a very powerful firm in Hong Kong, and from the famous London School of Economics. So just to summarize, come to Paradise, visit us in either location, but really, support our program. What you really want to do at this point, with the U.S. outperforming so much over the last 7 to 9 years, you want to start to diversify globally, and foreign markets are outperforming the U.S. You also want to be hedged. I don't think we're about to enter a massive bear market, but to be long and short means that if there is a downdraft like we saw in April, you're going to be fine. You'll skate through that. And really, you want to invest with veterans, particularly those if you're getting outside the U.S. And I've been investing globally, for 30 years. And do visit us. We have offices in either of these beautiful cities. So thank you for your time, and reach out if you want more information or a conversation. Thank you.